Washington just began testing the waters on establishing minimum price guarantees for strategic minerals, while simultaneously, crypto markets are experiencing severe turbulence, and authorities are attributing the mayhem to volatile market conditions. I had no intention of filming this content today. My beverage has literally gone lukewarm while my email explodes with messages. But when I catch wind that price interventions for metals might be discussed in the same breath as Bitcoin's tumble, it frustrates me because the headline version isn't telling the authentic story. Whether you hold gold, silver, mining shares, digital currencies, or simply standard fiat in a banking institution, you're entitled to the complete narrative. We're here on Thursday, the 5th of February, broadcasting from New York. Leave a comment sharing what day and date you're tuning in from. Let's begin precisely where this originates, with a presentation that sounded tedious but could potentially relocate trillions in capital. A senior official stepped forward and essentially declared that the international marketplace for strategic minerals is dysfunctional. Supply networks are delicate, overly concentrated, and simple to weaponize. Market values get pushed around by external actors that have zero interest in your domestic mining operations, regional employment opportunities, or sovereign security considerations. Then came the statement that should have grabbed your attention. Make pricing more foreseeable, reduce erratic swings, and capital investment will finally materialize. That seems harmless, correct? Stability and predictability. Who could object? But the instant you hear price floor, your immediate questions should be, a floor on what exactly? Financed by whom? Implemented through what methods? And lasting how long? This is where the terminology gets tricky. Governments almost never place a giant billboard on the marketplace announcing, here's the mandated price. They accomplish it through infrastructure, contractual arrangements, financial incentives, regulatory frameworks, elements sufficiently boring to bypass news headlines. It might manifest as multi-year procurement contracts where a government-supported purchaser commits to acquiring a minimum quantity at a guaranteed price point. It could appear as import duties that penalize underpriced foreign competition. It might look like a national stockpile program intervening when valuations collapse, not to generate profits, but to preserve supply chain functionality. The first public statement isn't the actual policy. The policy emerges through execution because market participants will challenge you. When you declare you'll protect a certain level, the quickest path for speculators to profit is hammering that threshold to see whether you'll retreat. So if this materializes into reality, anticipate a rigorous examination. Anticipate unsuccessful attempts. Then, anticipate the genuine result being determined in the tedious particulars. How much capital gets appropriated, which materials qualify as eligible, and whether allied nations genuinely synchronize. That's precisely why I'm tracking this attentively, because there's one interpretation of this that represents basic common sense. National reserves, extended term agreements, government serving as the purchaser of last resort when dumping, obliterates a project. And there's an alternative interpretation that transforms into an awkward, costly, politically expedient apparatus, one that explodes the moment the marketplace detects vulnerability. And here's the component most observers are overlooking. This transcends lithium or nickel or rare earth materials. When you establish a precedent that Washington will orchestrate price floors for strategic resources, what message do you think precious metals advocates hear? They hear the administration confessing that volatility represents a national security threat. They hear leadership desiring protective barriers on the raw materials powering contemporary existence. Then they raise the self-evident question. If you're willing to do this for the critical inputs, what prevents you from attempting it for monetary commodities? That's the reason this carries weight. Now, before we proceed deeper, there's immediate price movement that's generating emotional responses. I comprehend it. Throughout recent trading sessions, silver has been bucking violently, like it's attempting to eject riders from a mechanical rodeo attraction. One instant, it's surging higher, then suddenly, air pocket. Gold demonstrates identical behavior, just dressed in more sophisticated attire. According to recently released figures, spot gold has been hovering in the high $4,000 range per troy ounce after establishing a new all-time high toward the end of last month. Silver has been battling in that high 70s to low 80s territory with brutal intraday volatility spikes and reversals. If you've ever questioned why it appears metals ascend during darkness and decline during daylight, you're not fabricating that observation. I'm not leveling accusations at anyone. I'm simply stating that off-hours trading is when market depth gets shallow, and shallow depth is where peculiar phenomena occur. If you're a believer in coincidences, that's perfectly acceptable. I'm not present to strip that belief away from you. Now, let me provide you the element that makes this entire episode feel incorrect. Paper valuations and physical valuations are communicating two separate narratives. On a United States futures display, you observe one figure. On the physical ground, where participants actually accept delivery, you observe a distinct figure. Presently, that differential isn't minor. In Shanghai markets, silver has been exchanging meaningfully above the US futures benchmark at a substantial double-digit percentage markup that continues rebounding even when paper markets experience sell-offs. Absorb that again. If silver were genuinely abundant, you wouldn't witness purchasers in one of the planet's largest manufacturing regions paying a considerable premium simply to obtain possession of it. So when somebody declares, "Look, the price declined, situation resolved," I want to laugh courteously into a cushion. Because a reduced screen valuation doesn't magically refill storage facilities, it doesn't magically boost mine production overnight, and it doesn't magically diminish requirements from electronics manufacturing, solar installation, data infrastructure, and everything else utilizing silver like it's wiring for tomorrow's world. Now, let's address the element that silently drains ordinary investors: the bid-ask spread. If you've never purchased tangible metal, you examine spot pricing and you assume, acceptable, that's the cost. Then you attempt to purchase and you encounter a markup. Then you attempt to liquidate and you encounter another charge. Except this one operates backwards. It's essentially a markdown, a thanks for participating penalty. Presently, those spreads are unattractive. Certain dealers are presenting buy-side markups in the lower double-digit range. Some are offering well beneath spot to repurchase because they're frightened the subsequent 24-hour period delivers another violent price movement and they'll be trapped holding inventory that devalues before they can establish hedges. So let's be transparent. If you're acquiring physical material anticipating flipping it the next day, you're engaging in the incorrect activity. Precious metals aren't a short-term trading instrument. They represent extended horizon insurance, and insurance consistently carries something up front. Here's another pitfall people don't recognize until it inflicts damage. On days when silver and gold shift rapidly, the spread isn't merely a dealer being greedy. The spread transforms into a risk control instrument. If a business purchases from you at complete spot valuation and the marketplace crashes before they can establish protection, they can suffer catastrophic losses. Therefore, they expand the bid, they expand the ask, they attempt to survive. That's additionally why when you observe extreme premiums, it doesn't automatically signify shortage tomorrow. Occasionally, it signifies inventory is limited and nobody desires to be the victim standing motionless. So don't merely stare at the premium figure. Observe how extended it persists. Observe whether it contracts when volatility moderates. That's where the meaningful signal resides. Now, returning to the presentation. The official fundamentally described a sequence every commodity speculator recognizes. A domestic operation gets announced, capital begins materializing, the blueprint appears viable, then, almost like sorcery, new international supply materializes, valuations collapse, capital vanishes, and the operation terminates. Have you witnessed this motion picture? Naturally, you have. That's dumping. That's predatory valuation strategy. That's geopolitical maneuvering disguised as free market mechanisms. In critical minerals, it's not merely economics. It's power politics. So when you hear price floor, translate its meaning. It can signify will guarantee demand and a minimum valuation so you can finance the extraction operation. Or it can signify we're going to warp the marketplace and hope it doesn't detonate. Here's my dubious interpretation, because we require one. Price floors exclusively function if you possess three components: a trustworthy purchaser, a trustworthy enforcement structure, and a trustworthy determination to continue purchasing when it feels uncomfortable. If you lack those elements, the floor is merely a public announcement, and markets consume public announcements for morning nutrition. But the reality this is even being deliberated at an elevated level communicates something significant. Policy architects are finally confessing the invisible hand has been getting its wrist contorted. In Mineral Conference this week incorporated discussion of synchronized pricing floors among allied powers, explicitly characterized as diminishing dependence on a solitary, dominant provider. That's not a trivial declaration. That's fundamentally an admission the previous framework wasn't delivering resilience. Now, here's the complication. The identical individuals requesting foreseeable mineral pricing are simultaneously observing the monetary framework wobble, which delivers us to the alternative headline. Cryptocurrency getting demolished while metals refuse to perish. Bitcoin has been declining aggressively this week, momentarily touching levels approximately 70,000, following a broader technology-driven risk aversion movement. If you're a cryptocurrency advocate, you'll state it's merely volatility. If you're a metals advocate, you'll state, "Welcome to my typical weekday." And if you're an ordinary individual, you're sitting there contemplating, why does everything I possess move like it's connected by the identical invisible wire? Because it is connected. When substantial portfolios eliminate risk exposure, they liquidate what they can liquidate, not consistently what they should liquidate. Market depth becomes the weapon. Correlations converge to unity. That's why on catastrophic days, you'll observe equities down, cryptocurrency down, metals down, until the chaos settles and genuine safe haven assets reassert themselves. Now, amid this turbulence, a celebrated business personality went viral with an observation. Nobody's purchasing gold. Attempt to liquidate a substantial amount and observe what transpires. You'll receive offers way beneath spot. Meanwhile, cryptocurrency is instantaneous. Acceptable, decelerate. There's a kernel of validity and a mountain of absurdity in that. Kernel of validity. If you walk into a random establishment with a pile of metal and demand instantaneous liquidity at complete spot, you're going to experience disappointment. The dealer must verify authenticity, manage price exposure, and they're not a charitable organization. Mountain of absurdity. The conclusion that metals aren't genuine and cryptocurrency is more genuine. Reality is mundane. Distinct assets possess distinct settlement infrastructure, distinct fraud vulnerabilities, distinct liquidity characteristics, distinct functions inside a portfolio. Gold is not engineered to be a 5-minute transaction. And if your argument is, I can relocate cryptocurrency rapidly, congratulations, you discovered the feature that additionally permits it to crash rapidly. Here's an inquiry. If instantaneous settlement is the definition of genuine, then why isn't a wire transfer the most magnificent asset on the planet? Precisely. And I'm going to push back more aggressively. When you discuss liquidating $10 million of anything, you're not discussing the identical marketplace as the individual purchasing one coin. Institutional gold exchanges with spreads that appear nothing like retail coin spreads. It can be relocated in large ingots with secure custody chains and narrow pricing when you're in the appropriate channels. So if somebody utilizes retail spreads to assert nobody's purchasing, that's analogous to judging the entire housing marketplace by the valuation you received offered for a used piece of furniture. Now let's transition, because this subsequent section is where determinations begin altering lives. Price projections. A collection of major institutions have been circulating extremely aggressive gold predictions lately, figures that would have sounded absurd a couple years previously. Recently published estimates have positioned end-of-next-year gold objectives in the lower $6,000 range per ounce. And whether you believe those projections or not, the more significant point is why those predictions exist. Central banking authority demand, reserve diversification, and persistent suspicion in paper commitments. Central banking authority purchasing remained historically elevated through complete year 2025, with hundreds of metric tons added internationally. One additional point on gold, because individuals underestimate how psychological this has transformed. The recent couple years trained everyone to regard gold like the elderly generation asset. Then the valuation began acting like a momentum speculation. Now, even mainstream retail is gradually returning through funds and fundamental brokerage products, which is partially why oscillations are becoming sharper. That's not automatically optimistic. Retail can be transient capital. Retail can pursue trends. Retail can capitulate at the worst instant. But it does alter the marketplace's character. It signifies the subsequent pullback can appear like the conclusion of the world immediately before it transforms into the subsequent launching platform. And if you desire a straightforward method to sanity check silver versus gold without becoming a spreadsheet obsessive, observe the ratio. When gold is costly relative to silver, silver optimists state catch-up opportunity. When silver is costly relative to gold, gold optimists state quality over turbulence. Either way, the ratio communicates where the crowd is leaning, and crowds are frequently incorrect at inflection points. So affirmative, price projections make excellent video thumbnails, but positioning makes genuine results. That's not retail panic acquisition. That's institutions with infinite time horizons stating, we desire less exposure to someone else's promissory obligation. Now, does that guarantee linear upward trajectory? Negative. In reality, I'll state something that might frustrate gold enthusiasts. The higher the valuation ascends, the more brutal the pullbacks tend to be because profit extraction grows and leverage gets eliminated. But structurally, the bid beneath gold has been authentic. Silver is distinct, which is why silver is both exhilarating and frightening. Silver has manufacturing demand. Silver has a smaller marketplace. Silver compresses harder, and silver gets penalized harder when market depth evaporates. So if you're going to engage silver, you have to accept it can feel like a thrill ride, engineered by someone disturbed. Now, another data point that captured attention: reports of physical constraint in premiums, not exclusively in China, but in additional hubs also. When multiple geographical regions are paying double-digit premiums for tangible material, that's not a "nobody desires it" narrative. That's a "paper is discounting something physical is already pricing in" narrative. And this is where interpretation carries weight, because there are two feasible explanations. First, physical is genuinely scarce. Second, logistics, taxation, and friction are generating regional premiums that don't automatically equal worldwide scarcity. For instance, Shanghai's premium mathematics can be distorted by tax handling and importation constraints. So you can't merely eyeball one figure and scream shortage. Observe what I'm executing? I'm not cheerleading, I'm attempting to think analytically. Now, there was additionally conversation about a massive pessimistic wager against silver. Some substantial player leaning short immediately before a brutal decline. Perhaps it's accurate. Perhaps it's exaggerated. But even if it's accurate, here's the point. Substantial shorts don't prove silver is condemned. Substantial shorts prove silver carries significance. Because nobody constructs a $500 million position against something they think is irrelevant. They execute it because the compensation is enormous, or because they're hedging something you can't observe. And that delivers me to vault movements. Individuals love observing metal relocate into and out of vaults, like it's a live competition scoreboard. And affirmative, when a major exchange storage facility reports heavy withdrawals, that can carry weight. Recent exchange information in Asia has demonstrated notable inventory oscillations, which fits the broader theme. Physical is being extracted into the genuine economy. But again, don't regard one day's inventory alteration like a prophecy. Regard it like evidence. Now, before my guest reacts to all of this, I desire you to hold one additional concept in your consciousness because you've heard it previously. A legendary macro voice has contended for years. Fiat frameworks are stressed, debt accumulations are massive, and central banking authorities are selecting gold because it's the one reserve asset you can't manufacture. You don't have to worship that contention. But you do have to grapple with it. Because if the largest institutions on the planet are accumulating gold and policy architects are discussing stabilizing commodity pricing, you have to inquire, are we entering an era where governments openly manage more and more strategic valuations? And if so, what does that execute to your accumulated wealth? My guest's interpretation? He fundamentally stated the presentation sounds correct, but it's hollow. Not because the problem isn't genuine. The problem is genuine. Supply networks are fragile. Marketplaces get dumped on. Domestic operations terminate. But the presentation didn't quantify the blueprint. Which minerals? Which structure? How do you measure stability? And this is where he went complete engineer cognition. Volatility is quantifiable. If you're going to manage stability, you have to define the objective and define the instrument. Otherwise, you're merely waving your hands over a conflagration and hoping the flames behave. He additionally dropped the statement that will make half the audience applaud and half the audience furious. A substantial portion of this chaos is policy-generated. Subsidies, distortions, perverse incentives, political activities that encourage dumping and accumulation. His resolution was, fundamentally, stop pretending the marketplace is free when it's obviously being manipulated. Either make it genuinely free or be transparent you're managing it, and then construct frameworks that don't collapse beneath the weight of duplicity. I don't concur with every word of that, but I do concur with the foundation. You can't repair what you refuse to describe accurately. And presently, leaders are describing the symptom, price instability, without completely owning the cause, strategic rivalry. So the transparent answer on metal price floors is to be determined. But even to be determined carries weight because it communicates the conversation is transforming. Now we transition back to the viral commentary about gold market depth. My guest fundamentally took the opposite perspective of the cryptocurrency is superior contention. He stated, certainly, two perspectives make a marketplace, but metals aren't meant to be flipped. If you purchased precious metals anticipating to cash out tomorrow, You misunderstood the product. And he's correct. Gold isn't a trading token, it's a reserve. It's what you hold when you don't completely trust the regulations of the activity. Then he stated something I believe individuals need tattooed on their consciousness. If you can't tolerate the volatility, your position dimension is incorrect. If you're losing sleep, you're excessively large. Now, he additionally took a swing at the Bitcoin is a safe refuge narrative. And here's where I'm going to be more nuanced than both factions. Bitcoin isn't gold, that's self-evident. But Bitcoin isn't nothing either. It's a network with genuine adoption and genuine market depth. The issue is it exchanges like a risk asset beneath stress, and today is a perfect illustration. Bitcoin declined sharply alongside a broader liquidation in worldwide technology and risk assets as capital allocators got nervous and rushed toward traditional refuges. So if your blueprint is Bitcoin saves me during turbulence, you have to define what category of turbulence you signify. Because in the turbulence of a risk-aversion day, Bitcoin can behave like a leveraged technology equity with a more appealing logo. Now, I desire you to comment this. Do you desire government attempting to establish price floors for strategic resources? Or do you desire genuine free marketplaces, even if it signifies brutal boom-bust cycles? Because your response communicates what you think the subsequent decade appears like. All right, Bitcoin collapse segment. A rumor circulated about a major emergency assembly overseas and a giant liquidation of United States assets to defend a currency. Perhaps it's accurate. Perhaps it's social media creative fiction. Either way, even the rumor communicates something. Currency stress is back on the agenda. And you don't require to believe the wildest interpretation to take the underlying signal seriously. We do understand from the latest publicly available figures that currency and rate anticipations are shifting, and the dollar has been firming during bursts of risk aversion. We additionally understand commercial real estate isn't precisely healthy. Office-backed commercial mortgage-backed securities delinquency has climbed into the lower 12% range, establishing record highs in recent monitoring. That carries weight because delinquency is like fungal growth. If you observe it in one corner, it's typically in the structural components also. And then individuals state we're not in a recession. Acceptable, perhaps not officially, but leverage doesn't care what classification you utilize. If enough vulnerable structures exist simultaneously, overpriced technology, unstable offices, stretched consumers, then any shock can cascade rapidly. That's why Bitcoin's movement isn't transpiring in isolation. Now, let's discuss the actual Bitcoin recording. Today, Bitcoin declined toward the 70,000 handle, not because one individual hit liquidate, but because the entire risk complex wobbled simultaneously. And here's the element. When individuals observe substantial red candles, they instantly fabricate narratives. Some whale liquidated, some institution dumped, some exchange executed something questionable. Occasionally, those narratives are accurate. Frequently, they're merely psychological defense. The simpler explanation is typically the correct one: limited market depth, compelled liquidation, and the reflexive nature of leveraged marketplaces. And affirmative, cryptocurrency is leveraged, even when you personally aren't utilizing leverage because the marginal purchaser frequently is. Now, immediately after a flush like that, the promotional squad materializes. You understand the category. They communicate Bitcoin is ascending to 1.5 million, 10 million, 100 million, whatever figure grabs attention. And they state it with the confidence of an individual selling miracle vitamins from a trunk. And my inquiry is consistently the identical. What's the mechanism? Don't merely give me a destination, give me the bridge. Because if you can't explain the bridge, you're not explaining, you're marketing. Now, to be equitable, there is a genuine contention that volatility compensates disciplined individuals. If you possess more time than capital and you're determined to study, volatility can be opportunity. But it's additionally a guillotine for the indolent and the overconfident. Now we transition into something most finance channels won't address because it isn't flashy: accountability. I'll keep this abbreviated because I comprehend you arrived for metals and Bitcoin, not a civics lecture. But this carries weight because the theme repeats everywhere: who compensates, who benefits, and who gets away with it. There's an advocacy document my guest wrote, a case examination about a county-level tax assessment framework that was allegedly compromised through incompetence, conflicts of interest, and refusal to execute a genuine forensic audit. And the hook is brutal. Somebody in the chamber acted like they desired the truth, pushed for an investigation, then steered the board into hiring a feel-good review instead of a forensic teardown. A superficial piece instead of a microscope. If you've ever observed a corporation investigate itself, you already understand the punchline. Now, my guest's point was straightforward. Genuine fraud isn't resolved by atmospherics. It's resolved by evidence. He asserts a proper forensic audit could document the mechanics in days, not months, if you understand where to look and which information carries weight. And because that didn't transpire, he's releasing a scope of work template, something communities can adapt, so boards can't pretend they don't comprehend how to execute it. There's a link down beneath. No paywall, no gimmick. Now you might be contemplating, what does this possess to do with gold and silver? Everything, because macro is constructed on micro. When individuals lose trust locally, tax frameworks, bond frameworks, governance, they begin hunting for assets outside the framework. That's how you obtain a gold resurgence, not merely because inflation exists. Inflation consistently exists. Gold moves hardest when credibility collapses. Now he proceeded further. He contended the root issue isn't complicated. Zero accountability. Officials approve massive debt. Consultants write reports to justify it. The identical individuals who benefit from spending your capital additionally get compensated to communicate it's acceptable. Then years later, the bill materializes. He cited the growth in municipal and school district bond burdens, and he warned, households get crushed not merely by principal, but by the compounding interest accumulated on top. Now, I'm going to add a fresh data point so this doesn't sound like pure rhetoric. We already mentioned office commercial, mortgage-backed securities delinquency hitting record highs, which is one visible crack in the debt wall. And recent marketplace updates suggest the stress isn't isolated to one building or one city. It's broad enough that lenders and insurers are repricing risk across entire categories. That's not ideology, that's mathematics. Now he tied this to power grids and data centers, fundamentally stating we're going to require huge upgrades and the instinct will be to issue more bonds, even though the framework is already strained. Then he inquired the uncomfortable question, if the capital doesn't exist today, how does it magically exist tomorrow? Equitable question. But here's my counterpoint, because I promised independent thinking. The capital can exist in the sense that governments can raise taxation, cut alternative spending, or inflate away obligations. Those are all methods of forcing the capital to exist. The question isn't whether resources can be extracted. The question is what category of society you obtain after they execute it. Then the document took a philosophical turn, quoting an old revolutionary writer about power, monarchy, and the disease of absolute control. He modernized it into a warning about governments picking winners and losers, and how political machines become permanent. You can concur or disagree with his politics, but the deeper point is useful. Once a framework begins managing outcomes, it rarely stops at the first outcome. And that loops us directly back to the start. Price floors, commodity stability, strategic stockpiles. These aren't isolated policies. They're signals about how leaders see the world, as something to be managed, not something to be trusted. That's why gold and silver keep materializing in the conversation, even when cryptocurrency is the shiny toy. So here's my second inquiry for you. If you attempted to purchase or liquidate physical silver in the last 30 days, what premium or discount did you actually observe? Because your genuine world experience carries more weight than anyone's hot interpretation. Now, I'm going to land this plane. We commenced with governments floating coordinated price floors for minerals to keep supply networks alive. We observed metals whip around, while physical premiums refused to perish, even as paper got punched. We observed cryptocurrency decline with risk assets, and learned again that instantaneous doesn't signify safe. And we ended on the reminder that the trust problem isn't merely macro, it's local. If there's one practical takeaway, it's this. Don't confuse valuation with value. Don't confuse velocity with safety. Don't confuse a headline with a mechanism. And don't put yourself in a position where one catastrophic day compels you to liquidate the element you desired to hold. If you don't desire to miss the subsequent update, hit subscribe, because this narrative isn't finished. It's about to get more peculiar. None of this is financial advice.